Have you ever thought about how a $1.7 billion investment can transform a cityscape? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In Fort Worth, Texas, a colossal $1.7 billion mixed-use development is making significant strides forward. This ambitious project, spearheaded by Larkspur Capital and Keystone Group, is set to energize the real estate market on the city's western side. The development, which spans 37 acres, has recently received the green light with the approval of incentives, a crucial step in its progression. According to Seth Bodine from the Dallas Business Journal, this development could potentially supercharge a real estate boom in Fort Worth, a city already experiencing rapid growth and transformation. Now, let's pivot to the Canadian perspective. In the Kitchener-Waterloo region of Ontario, we're seeing a parallel interest in mixed-use developments, albeit on a smaller scale. The focus here tends to be on integrating residential spaces with retail and office environments to create vibrant community hubs. While not as vast as the Fort Worth project, these developments are pivotal in addressing the region's growing population and demand for multifunctional spaces. From a cross-border perspective, these developments underscore the broader trend of urban transformation through significant investments in mixed-use properties. Whether in Texas or Ontario, the emphasis is on creating environments that offer live, work, and play opportunities, a concept that continues to gain traction across North America. Boston-based Bain Capital Real Estate and 11 North Partners have announced their joint acquisition of a significant open-air retail portfolio in Oklahoma City, valued at approximately $212 million. This acquisition marks a major investment in one of the city's most dynamic retail corridors, highlighting the growing trend and confidence in open-air retail centers. The portfolio includes 3 premier properties, Nichols Hills Plaza, Class and Curve, and the Triangle at Class and Curve, all located in the upscale Nichols Hills submarket. Together, these properties span nearly 40 acres and boast occupancy rates exceeding 97%. Anchored by national retail powerhouses like Whole Foods and Trader Joe's, the centers also feature over 50 unique-to-market brands such as Lululemon, Sephora, Anthropologie, and Warby Parker. This acquisition was made possible through a strategic joint venture formed in 2024 between Bain Capital Real Estate and 11 North Partners, a retail-focused investment platform led by industry veteran Brian Harper. The venture targets open-air retail centers across the United States and Canada, focusing on convenience, community, and necessity-based retail. Brian Harper, managing partner at 11 North, emphasized the strategic value of this acquisition, noting that these properties are not only well-leased, but also serve as dominant lifestyle destinations in the region. The strategic positioning of these centers, near Integris Baptist Medical Center and Chesapeake Energy's headquarters, contributes to high traffic and superior local demographics, driving strong retail sales and consistent tenant demand. Martha Kelly, managing director at Bain Capital Real Estate, stated that this acquisition aligns perfectly with their investment strategy, focusing on high-quality, well-located retail properties that are essential to daily life. The transaction underscores a growing investor confidence in open-air retail centers, which have shown strong performance and tenant demand post-pandemic, particularly in markets with stable population growth and solid economic fundamentals. Walker & Dunlop Investment Partners has announced the closing of its 7th discretionary equity fund, Fund 7, which is a $135 million opportunistic vehicle. This fund is focused on multifamily and industrial real estate across the United States, targeting 15% or higher net returns and 1.5 times or greater net multiples. The fund aims to capitalize on underutilized and mispriced assets with actionable value enhancement plans, positioning itself in a market that the team believes to be exceptionally favorable. Managed by Brian Cornell, Ryan Castle, Marcus Dooley, and Mitch Resnick, Fund 7 has already seeded 8 investments, encompassing over 50% of its capital commitments. The fund's core focus is on middle market deals with equity checks ranging from $5 million to $25 million. This strategy is designed to deploy capital quickly and efficiently, taking advantage of current opportunities and limited competition among equity providers. Brian Cornell, one of the managing partners, described Fund 7 as a smaller, tactical equity vehicle. He emphasized the fund's role in swiftly deploying capital in a space that is ripe with opportunity. This strategic focus allows Walker and Dunlop investment partners to leverage market conditions effectively, particularly in the multifamily and industrial sectors. In downtown San Diego, the rise of empty office spaces is becoming increasingly noticeable. As reported by Steve Price on June 26, 2025, the area is witnessing a significant increase in vacancy rates, which is raising concerns among local businesses and city officials. This trend is part of a broader shift in the commercial real estate market, influenced by changing work patterns and the growing preference for remote work setups. The data shows that companies are reassessing their office space needs, often opting for smaller, more flexible work environments. This shift is not unique to San Diego. It's a pattern observed in several urban centers across North America. As businesses continue to adapt to the post-pandemic landscape, the demand for traditional office spaces is declining, leading to more vacant properties in downtown areas. In comparison, the Kitchener-Waterloo region in Ontario also faces challenges with office space utilization. However, the region is witnessing a different trend, where tech companies are driving demand for innovative and collaborative workspaces. These spaces are often smaller and integrated with advanced technology to support hybrid work models, reflecting a nuanced approach to office space management. The situation in San Diego highlights the need for strategic planning and adaptation in the commercial real estate sector. As cities like San Diego and Kitchener-Waterloo navigate these changes, the focus is shifting towards creating versatile spaces that can accommodate evolving business needs. This includes exploring mixed-use developments and repurposing existing buildings to better serve current market demands. In Corsicana, Texas, Phoenix Investors has announced a strategic acquisition of a massive industrial complex, marking a significant expansion of their portfolio. This newly acquired facility, located at 2200 South Business 45, adds approximately 1.5 million square feet across a 172-acre site to their holdings. With this acquisition, Phoenix Investors now oversees over 82 million square feet of commercial real estate nationwide. The complex, originally constructed for Kmart and later used by Home Depot as a logistics hub, showcases its high-quality construction and strategic location. Positioned with direct access to Interstate 45, it offers a vital connection between Dallas and Houston, making it an ideal site for logistics and distribution. As of the closing, the facility is fully occupied, featuring 109 dock doors and 983 trailer parking spaces, along with heavy power capabilities and clear heights ranging from 26 to 28 feet. Notably, the facility underwent major renovations in 2018, which included a new roof installation and enhancements such as full perimeter fencing, secure access, abundant parking, and a comprehensive compressed air system. Looking ahead, approximately 250,000 square feet of space will become available for lease in October 2025, with an additional 375,000 square feet expected to be available by January 2027. This offers significant room for future expansion and the ability to accommodate a broad range of industrial users. Anthony Crivello, Executive Vice President and Managing Director at Phoenix Investors, highlighted the facility's robust infrastructure and strategic location, emphasizing its alignment with their investment strategy. Crivello noted that this acquisition provides a compelling value proposition, particularly when compared to current market rates in Dallas. This acquisition is part of a broader expansion strategy by Phoenix Investors in 2025, which includes recent acquisitions in Memphis, Tennessee, Paris, Kentucky, and Roanoke, Virginia. Overall, the firm has acquired about 6 million square feet this year, reinforcing its aggressive growth across the United States. As we wrap up today's episode, it's clear that strategic acquisitions like these are reshaping the commercial real estate landscape, providing new opportunities for growth and development. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.